Greetings, Jonathan Camarda, your favorite CIO, with a market wrap. And what a vertigo week it's been, as in giving us all vertigo. So where to start? We'll start with the macro picture of what we're looking at, and then finish up with the technicals where we see it right now. And currently, from a macro standpoint, some mixed numbers. Right now, surprisingly, Q1 GDP, gross domestic product, Q on Q, Q1 negative 1.4%. So very interesting there because the consumer has remained pretty resilient. One of the things that we're looking at that has probably caused that is an excess of imports. And imports generally, when they are exceeding exports, can weigh on GDP. Now, the excessive imports could work out if we continue to see consumer demand could turn into future growth as those finished, unfinished products are put and sold, eventually produced, etc. If demand wanes, then the extra imports could cause a drag to the downside with excess inventories. So very interesting if you saw the GDP numbers come out. Earnings. Now, as we jump to earnings, it's been an interesting mix as well. Certainly, a delineation between the haves and have-nots. We've seen the car wrecks like Netflix's and such, and some of the ones which actually looked pretty good, like Apple's. And then in between, we've had some that, again, were not so great, but the stocks reacted pretty well, like Facebook, because it was so oversold. Not that the earnings was stellar. So pretty interesting dichotomy there. The one thing we're taking out of earnings season, however, is sales remain resilient. And with inflation, that actually has improved sales. And pricing power has continued to be there. That means that the companies are able to pass the prices on to us, and we keep asking for more. So that has increased sales, which is looking good. Now, what point does that stop? And that could be a concern as well, if we continue to either pay higher prices or we say no. And then that obviously causes a slowdown. Now, the other thing that we're looking at as well is margins. We've heard margins. And margin, if you watch Shark Tank, like my kids and such, is, how much you can sell something for above what you make it, right? What it costs to produce. So margins has been, mentioned as well as inventories more than on average, which says, again, there is potential for a slowdown. Although after the Q1 numbers, still recession might be out there on the horizon. Everyone's talking about that. Not necessarily blatant in the cards at this juncture. However, the negative GDP number certainly makes the Fed's job a little harder, right? Negative GDP, and we keep raising rates to stave off inflation. So again, it is a gray area, as they are expected, of course, as we'd already talked about with Jay and company going with 50 basis points probably in May, as we look at that. Now, we've had definitely, over the last few weeks and a couple of months, the strongest sectors, as you know, which we've been participating in and, again, trying to hedge in this challenging market: energies, utilities, consumer staples. So if you'll notice in your portfolios that those have been, bulwarks, no pun intended. And, of course, over the last week or two, as we've been shaving off mid and small caps, those have been weaker than the large caps. And in this environment, that has been the case. Now, that's somewhat oxymoronic because one thing that is really causing a headwind is the strong dollar. Now, you might have noticed that we're participating in the dollar in some of your strategies. Of course, this is bad for companies, multinationals like your Coca-Colas and your Nikes selling overseas, right? Because the more expensive the dollar is, the more expensive their products are when you do the currency exchange, which could cause a headwind. Has not been crazy yet, but that could be a story. Now, the dollar continues to be the strongest currency globally, especially versus a very weak currency like the yen in Japan. So again, while that hurts some sales on an international level, it's really not a surprise, right? Because as the Fed looks to lift rates, the higher rates are the short-term rates. The global game of currency exchange, the way it's played is the strongest currency on the block gets the most money, right? Just think about a kid in school with lunch money, right, at the sandbox, so to speak. And that's kind of what it's like. So with the stronger dollar, more money is invested here, and it's continued to cycle. We'll see again if that continues. Now, as far as equity markets, you can see that we've had some relief rallies like yesterday, but still the trend has been more dour as the S&P, NASDAQ, and the Dow Jones have all below their 50-day moving averages, and their 50-day moving averages are all below the 200-day moving averages. And if a train leaves LA at 5 a.m., what does that mean in English, Jonathan? That means that, again, the trend is down. So therefore, we are holding more cash and more defensive positions. Now, the last note I'll make of you say, hey, well, why are we holding equities in general? Well, the put to call ratio, again, if you're not familiar with options, puts mean you're selling, right? The large institutions use options, very heavy quantities, and from a leverage standpoint. When you're putting something, it means you're betting against it, and when you're buying a call, you're betting for it. So when we look at the institutional put to call ratio, that is bets of short the market versus long, gets to excessive levels, that generally tends to be a bullish catalyst. Now, we were looking at mid-June as that may be hitting an apex where we can get really bullish, but that may actually come closer in time frame, metaphorically, proximity wise, in that the put to call ratio now is at 1.15. So that means think 115%, right? So put 1.15 versus calls, that is heavy on the bearish side. Once that starts to teeter too heavy, the bus gets full, you generally see a mean reversion or reverse of course. So we tend to be, invested in different areas, given those metrics. If you have any questions, of course, going through your quarterly reviews or, with your PWAs from a macro standpoint, just let us know. Certainly here to serve. As again, a pleasure and a privilege to serve you guys, as we appreciate your time, your patience, and most importantly, your trust. Easy for me to say. Has it been a long week? Listen, have a great one. If you guys have any questions, let me know. Let us know. We're here to serve, and try to have a great weekend as we continue to roll up our sleeves. Peace.